So the big question is this: how do investors like us who trade options and manage our own money generate income regardless of where the stock market goes, and do it all in a way that lets us make time for the people and things we love, and yet still build wealth and remain profitable? That's the question, and this podcast will give you the answer. I'm your host, Kirk Duplessis, and you're listening to The Daily Call from Option Alpha. Hey everyone, this is Kirk here again, and welcome back to The Daily Call. On today's call, we are going to be talking about the differences between systematic versus unsystematic risk in the market. I think this is an interesting discussion, and it gets me back to my roots, I guess, of old finance class in college. But it's a concept that I think all investors have to understand. It's a very easy concept. It can be a little bit overwhelming just by the terms and the names, but it's actually very, very simple to understand if you take just 2 minutes here today in our call and podcast to understand the differences between them. So there's two types of risk, broadly speaking, in the market. The first type of risk is risk that is specific to whatever underlying security or industry you are investing in. So to use the furthest end of the extreme spectrum, let's say that you're going to invest in Apple computers and Apple technology. Well, you have risk in just investing in Apple. Apple has its own risk profile, basically. It's a tech company. It's in the technology space. It has software. It has subscription services. It's definitely not an industrial manufacturing company, right? It is not a real estate investment trust. It is not a biotech company. So all of those other companies have their own risk profiles, and Apple has its own risk profile. So when you invest in Apple, you have risk that Apple is going to go under or be overshadowed by some other emerging technology that we don't even know about, or there could be a shift in consumer pricing and sentiment and people don't buy their products anymore. There's all of this risk associated to that particular security which you're investing in. That type of risk is called specific or unsystematic risk. Now, the way that I always think about it is with these two terms. I think system, meaning the entire system. So that's probably the easiest way I always think about it, is that systematic risk is risk to everything and everyone. Unsystematic risk is risk that is particular to one particular company. It's not risk that is present to the entire ecosystem or the entire investing universe, the entire global market. So when you have unsystematic or specific risk, that is risk for every single security that you're trading. Each individual security that you're trading has its own little unique risk profile. Now, the interesting thing about this is that when you look at modern portfolio theory and diversification theory, you realize that that unsystematic risk can be diversified. So you can not only just invest in Apple, but you can spread your risk or your investment across many different securities and different industries. So even simply investing in, say, a real estate investment trust or a REIT, which buys or sells property, just having those two positions now in your portfolio versus just one position in Apple can now reduce the amount of unsystematic risk because now your risk is spread across two different industries, two different sectors. And they also commonly refer to unsystematic risk as diversifiable risk. So you can diversify out of it. You can actively do something to manipulate the amount of risk in your portfolio by not investing all of your eggs in one basket. You can invest in this company, in that company, in this sector, in this industry, right? It's often thought that the S&P 500, and is probably true, that the S&P 500 is consistently the best combination of 500 securities that creates the least amount of risk per unit of potential return. So it's the market efficient portfolio. That's why it's the S&P 500. That's what it was built around. So it's 500 securities in that basket that create the best combination of risk return profile. Now, even still, the S&P and every other stock portfolio out there has what's called systematic risk. As we described earlier, systematic risk is applicable or applied to the entire ecosystem or the entire investing global market. And it's risk that you cannot diversify out of. Now, risks that you cannot diversify out of are things that affect the entire macroeconomics of global markets, right? So things like interest rates, inflation, market recessions, sovereign debt crises that we don't see, wars that we don't see happening. There's so many things that could be lumped into this systematic risk category. And the reality is that investors are always taking on some level of systematic risk. We don't know what's going to happen in the future. That's why black swans are present. That's actually why a lot of options traders make money selling options, because of this unknown in the future that they have to hedge against. So systematic risk is, again, risk that you can't necessarily diversify yourself out of. Even if you had a bunch of different securities in a bunch of different industries, at some point, there's going to be some market correction or market drawdown that happens that affects a lot of different securities or a lot of different industries, maybe a ton of different companies globally or countries globally. And so that is the type of risk that you are just naturally going to assume. Now, we try to minimize, when you build out a portfolio, the unsystematic risk versus the systematic risk, right? That's even what we do in options trading. Like in my account, what I try to do is I try to every single month build out a portfolio of many different ETFs and tickers in different industries and sectors, so that I try to minimize the amount of risk or exposure that I have to one particular area. So I won't invest in just, let's say, FXE and FXY, which are two currency ETFs, right? That would be stupid of me to invest just in currency ETFs. I would want to also invest in other things like the S&P or XRT, which is a retail ETF. We could do gold or silver or a commodity like oil. We could do semiconductors or biotech or healthcare. There's so many different things that you can invest in. You try to get a pretty good mix in your portfolio so that you reduce this amount of unsystematic risk that's tied to one individual security. So again, I think this concept on the outside is sometimes really hard for people to understand, but if you followed today's podcast, and hopefully you did, it's a very easy concept to finally grasp once you just take a couple minutes to just slow down and understand what we're trying to do. And it's not that all systematic risk can be avoided, because it can't, right? That's unavoidable, undiversifiable risk. But what you can do is you can reduce the position size of all of these individual positions so that you still leave money on the table, you still have cash in reserve. So if a huge systematic event does occur, especially in stocks, and you're 100% long in stocks, you have money left over to trade. Now, as a side note, what none of this includes, in my opinion, and has really been covered deeply in the market and the media, is that when you introduce a level of options trading to all of this, it creates the ability to profit from down moves. And when you hedge with options or use an options trading strategy where you're market neutral, even if the market goes down and there's this huge systematic event risk, it still won't necessarily affect an options trader's portfolio. You might have a sting from the initial move lower, but it won't necessarily cripple you. And that's, I think, something that options trading can give that traditional stock investing on the long side, the long equity side, doesn't really have the ability to do. So hopefully this helps out. As always, if you guys have any questions, let me know. Until next time, happy trading. Thanks for joining us on the Daily Call. Be sure to subscribe right now for more daily options trading ideas, strategies, and tactics to help you learn how to place smarter, more profitable trades. And if you like what we're doing, don't forget to give us a rating and a review so we can continue to bring you the best daily content possible. We'll see you again tomorrow, right here on the Daily Call from OptionAlpha.com.